Everyone is panicking about Meta. For the last few months, this stock has been under constant pressure. It has been drifting lower and lower, while the rest of the market has been hitting all-time highs. Wall Street looks at the spending estimates and sees dead money. They look at the massive AI bill coming due this year and say Mark Zuckerberg is burning cash again. I disagree. In fact, I think this pullback is the single most misunderstood opportunity in the entire S&P 500 right now. While the market is selling out of fear, I am buying with conviction. Today, I am going to show you exactly why Wall Street is wrong about Meta's spending and why this multi-month sell-off might be the last chance to buy a monopoly at a value price. But first, welcome back to Rebuild Finance. This channel is about documenting a long-term investing journey, building a portfolio over time, and sharing the thinking behind each decision without hype. My goal is simple: to find elite businesses, buy them at fair prices, and hold them for the long run. And right now, no company fits that description better than Meta. Before we get into the valuation, we need to clarify what the fear is actually about, because the narrative has changed. 3 years ago, in 2023, everyone was terrified that Zuckerberg was wasting billions on the metaverse and virtual reality. That was the old fear. Today, in 2026, the fear is different. It is all about AI infrastructure. Meta is planning to spend between $115 and $135 billion this year on AI infrastructure. That is nearly double what they spent in 2025. That money is going into massive data centers and custom chips to train their AI models. That is a staggering amount of money. Investors are worried that this is a field of dream strategy. Build it and hope it pays off. They're asking, where's the immediate return on investment for all these billions? But here's the reality they are missing. This spending isn't a science experiment. It is directly improving the core business. The reason you are seeing more relevant ads on Instagram today is because of this AI investment. The reason users are spending more time watching Reels is because of this AI investment. This spending is deepening their moat, not digging a hole. So the question is not, why are they spending so much? The question is the core business strong enough to pay for it? And that is what we are going to analyze right now using my 4-pillar framework, the Rebuild Finance Check. Pillar number 1, the business quality. The question here is simple. Does this company have a real competitive advantage? For Meta, the answer is obvious. They have one of the strongest moats in the world. Their moat is the network effect. Every person on Instagram makes Instagram more valuable for everyone else. Let me show you the numbers that prove this. Look at their operating margin. The operating income of the company was $81.5 billion, while revenues were $201 billion. This puts operating margins at over 40%. That means for every dollar of revenue they generate, they keep 40 cents as operating profit. Only elite businesses can do this. Compare that to traditional media companies or even competitors like Snap. They are struggling to break even. Meta is printing money. Note that the overall net income of Meta for 2025 decreased compared to 2024. But this decrease is fully attributable to an extraordinary tax expense of $25.5 billion. Given all this information, Pillar 1, the business quality, is definitely approved in my opinion since Meta has a strong quality business. Pillar number 2, the growth engine. Is Meta still growing, or is it a mature business that is stagnating? The narrative right now is that Meta's growth is over, but look at the actual revenue numbers. In 2025, Meta grew revenue by over 22%. That is not a dying company. That is a company that is still in growth mode. And here is the key. The growth is coming from efficiency. Meta has integrated AI into their ad targeting system, and it is working. Advertisers are getting better results, so they are spending more money. And with all the AI related spending they're doing, this is why I believe growth is not over. So even though user growth has slowed in some markets, revenue per user is going up. That is exactly what you want to see in a maturing business. Pillar 2, growth engine, passes. Pillar number 3, the financial fortress. This is where we look at the balance sheet. Can Meta afford this massive AI spending? The answer is yes. Meta has one of the cleanest balance sheets in big tech. They have over $80 billion in cash and short-term investments. Their net cash position is massive. This is critical because it means they are not borrowing money to fund these AI data centers. They are paying for it with their own wallet. Speaking of wallet, let's talk about free cash flow. In 2024, they generated over $50 billion. In 2025, that number dipped slightly below 50 billion. Why? Because they have already started the massive spending cycle on AI infrastructure. The capex bill is eating into the cash flow temporarily. But even with this historic spending, they are still generating tens of billions in cash. That is the definition of a fortress. So pillar 3, financial fortress, passes easily. Now let's talk about the most important pillar. Pillar number 4, the valuation. This is where we figure out if the stock is actually cheap. Right now, Meta is trading at a PE ratio of around 29. That means you're paying $29 for every $1 of annual earnings. Is that expensive? Let me give you some context. Compare that to the rest of the tech sector, which trades at an average PE of over 31. Meta is significantly cheaper than the sector average, and it is still growing revenue at over 20%. The market is pricing Meta as if their AI spending is going to destroy profitability forever. But history tells us the opposite. Every time Meta has invested heavily, they have come out stronger. So pillar 4, valuation, also passes. Let me summarize. Meta passes all 4 pillars of the rebuild finance check. They have an elite business with a real moat. They are still growing revenue at double digits. Their balance sheet is fortress strong, and the stock is trading at a discount to its peers. The market is selling because they are scared of the $65 billion price tag on AI. But I am buying because I believe that spending is going to secure their dominance for the next decade. I am treating this dip as a gift. I am adding to my position, and I will continue to hold as long as the thesis remains intact. Now, I want to hear from you. Are you buying this dip, or do you think the spending is out of control? Let me know in the comments below. If you found this breakdown helpful, please hit that like button. It really helps the channel grow. And if you want to follow my journey building a portfolio to 1 million, make sure you subscribe. Thanks for watching, and I will see you in the next one.